As we begin 2025, our view is that the US market looks marginally cheaper than most other G7 bond markets, especially Europe. So our core theme is that we will see fiscal expansion. Clearly, we're going to see that in the US and the UK. We don't particularly like gilts for that reason. But the market has that priced in. Places it's not priced in is core Europe, so we would generally prefer the US from that perspective. We do expect to see a small further degree of unwinding of the Trump trade. So again, that should favour places like the US over other jurisdictions. And then lastly, we like countries where we have perhaps a higher degree of political stability, places such as Australia, where the market is still expecting interest rates possibly to go up. But all the evidence we see is that they're likely to cut.
So in credit, we overall prefer Europe. It's structurally cheap to the US, and from this standing point, you generally see Europe outperform the US when it coming from this standing point. And we're seeing much more opportunity in the primary market at the moment, very little opportunity in the secondary market because spreads are so expensive. So actually eking out alpha, positive alpha from investing in the primary, where we're seeing decent new issue premiums. Again, though, also because we're more global in the way we operate over the fund, we're able to be nimble and come out of the different geographic opportunities. And for example, in August in 2024, we did see US spreads, quite quickly blow out at the first 2 weeks of August, and we were able to tactically move into the US in those 2 weeks, but since have moved back into an overweight in Europe. And we think we'll have more opportunity to do the same in 2025.